Ladies and gentlemen, listen carefully. If you are holding 500 O's of silver right now, you need to understand something that most investors still haven't grasped. This is not about a good trade anymore. This is not about catching a price move or waiting for silver to finally break out. This is about position. And more importantly, it's about what your position represents inside a system that is beginning to fracture in real time. I am not speaking in hypotheticals. I am not talking about a minor correction or a temporary cycle. I am talking about structural change because what Ray Dalio is signaling right now is not subtle. And if you miss it, you will misunderstand the entire role silver is about to play in the global financial system. Most people who own silver today bought it casually. They heard it was undervalued. They saw a price chart. Maybe they were told it was the next gold. That is not strategy. That is noise. What Dalio is describing is something entirely different. He is talking about positioning yourself in advance of a shift that historically does not happen often, but when it does, it reorders wealth on a massive scale. And you need to be very clear on this. The real question is not whether silver will move. The real question is whether you understand why it will move and what that means for everything else you own. Because if you don't understand that, you will not hold your position when it actually matters. Stay with me. Because by the end of this, you are going to see your 500 odds differently. Not as a static holding, but as a strategic anchor inside a system that is becoming increasingly unstable. Now let's establish the reality we're operating in. We are living through a moment that history has shown again and again leads to one outcome. And no, this does not end quietly. There are three structural forces unfolding simultaneously right now, and most people are only seeing fragments of them. First, the debt dynamic. You need to understand this clearly. We are no longer in a phase where debt can be managed through growth. We are in a phase where debt must be managed through currency. That is a completely different environment. When governments reach a point where obligations exceed any realistic path of repayment, they don't default outright. They devalue, they extend, they inflate. History has proven this across every major debt cycle. And the scale we are dealing with today is not small, it is systemic. Second, the monetary shift. Most people still believe the global system revolves securely around one dominant currency. That assumption is being challenged in ways that are subtle but accelerating. Nations are diversifying reserves. Trade relationships are evolving. Confidence, which is the foundation of any monetary system, is no longer absolute. And when confidence begins to fragment, capital does not disappear. It moves. It searches for neutrality. It searches for something that is not tied to policy decisions or political pressure. You need to understand what assets historically absorb that movement, because that is where positioning matters. Third, and this is where silver becomes impossible to ignore, is the convergence between monetary demand and real-world necessity. Silver is not just a financial asset. It is embedded in the infrastructure of the modern world, energy systems, technology, industrial expansion. Demand is not theoretical, it is required. And when you combine required demand with constrained supply and overlay that with monetary instability, you don't get a normal market, you get pressure. Now, here's the critical point most people miss. Any one of these forces alone would justify holding silver, but all three happening at the same time creates something very different. It creates inevitability, not in timing, but in direction. And this is exactly why Dalio frames this as strategic, because strategic positions are not built on short-term expectations. They are built on asymmetry. They are built on scenarios where the downside is limited, but the upside is tied to systemic shifts. And silver at this moment sits directly in that category. You need to stop thinking in terms of will it go up this month? That is the wrong question. The right question is this: what happens to assets like silver when debt expansion forces currency devaluation, when confidence in monetary systems weakens, and when real-world demand continues to rise at the same time? Because when you answer that honestly, you begin to understand why your position is no longer passive. It is active, it's participating in a shift that most people are not prepared for. Now, let me be very direct with you. Most investors are completely blind to what is forming. They are still operating inside a framework that assumes stability. They believe central banks can control outcomes. They believe markets will adjust smoothly. They believe risk is temporary. That belief has existed before, and it has been proven wrong before. This is not new. Cycles like this repeat because human behavior repeats. The only difference now is scale, and scale changes consequences, which brings us back to you. If you hold 500 ounces of silver, you are not just observing this environment. You are positioned inside it. The question is whether you understand the role you are playing, because if you don't, you will treat this like a trade. And trades get exited, strategic positions get held. There is a difference, and that difference determines outcomes. In the next part, I'm going to break down exactly what Dalio means when he defines something as strategic and why that framework completely changes how you should think about your silver from this point forward. Stop thinking short term. Start thinking structurally, because this is already in motion and you are already in it. Now, you need to understand what strategic actually means in this context, because this is where most investors get it completely wrong. They hear that word and they assume it means important. It doesn't. It means necessary. There is a difference. When Dalio talks about strategic position, he's not talking about something that performs well in a specific environment. He is talking about something that maintains relevance across multiple environments, especially the ones that break everything else. That is the framework you need to shift into, because if you are still thinking in terms of isolated outcomes, bull market, bear market, rate cuts, rate hikes, you are already behind. Strategic positioning is about preparing for a range of outcomes where traditional assumptions fail. And right now, the range of outcomes is widening. You can feel it. Volatility is not random. It is a signal. Policy decisions are becoming reactive, not proactive. Central banks are no longer steering, they are responding. And when that shift happens, the system becomes less predictable. This is exactly the type of environment where strategic assets begin to matter. Now, let's break this down clearly. There are very few assets in the world that can perform under multiple forms of stress. Most assets are conditional. Equities need growth, bonds need stability, real estate needs liquidity and favorable financing conditions. Remove those conditions and performance breaks down, but silver does not operate under a single condition. It operates across multiple dimensions simultaneously, and this is where its power comes from. If inflation accelerates, silver responds. If currencies weaken, silver responds. If industrial demand increases, silver responds. If confidence in financial systems declines, silver responds. You are not betting on one outcome. You are positioned across several. That is what makes it strategic. Now, I want you to think about something deeper, because this is not just about markets. This is about behavior. When uncertainty increases, capital changes its behavior. It becomes defensive, it becomes selective. It moves away from complexity and towards simplicity. This has happened in every major financial transition. When trust declines, people stop relying on promises. They start relying on things that do not require trust. Physical assets, tangible value, something that cannot be diluted or restructured. And this is where most people underestimate what they are holding, because silver in its physical form does not depend on anyone else's liability. It does not require a counterparty. It does not need validation from a system that itself is under pressure. That independence is not theoretical. It becomes critical when systems are stressed, and we are moving closer to that type of stress. Now, let me take this one level further, because there is another layer to this that most investors have not even considered, and it has to do with positioning relative to the majority. In every cycle, wealth is not just created by being right. It is created by being early and holding long enough. Most people fail on the second part. They either enter too late or they exit too early. Why? Because they are anchored to short-term feedback, price movements, headlines, narratives. They react instead of holding conviction. This is where strategic positioning becomes psychologically difficult. because it requires you to operate outside of immediate validation. Silver is one of the most misunderstood assets in this regard. It does not reward impatience. It tests it. It moves in ways that shake weak conviction. It underperforms when attention is elsewhere. It becomes quiet when speculation dominates other areas. And then, when conditions align, it moves aggressively, not gradually, decisively. This pattern has repeated multiple times, and it catches the majority off guard every time. The people who benefit are not the ones chasing the move. They are the ones already positioned before it begins. That is the difference you need to internalize. Because your 500 Oz is not just a holding. It is a test of whether you understand the environment well enough to stay in position when nothing appears to be happening. And this is where most people fail. They get pulled into comparison. They see other assets moving. They question their decision. They lose patience, and they exit right before the conditions they were positioned for begin to materialize. You cannot afford to think like that, not in this environment, because the forces we are discussing are not short-term catalysts. They are structural shifts. They take time to build. But once they reach a certain point, they accelerate. And when they do, repositioning becomes difficult. Prices adjust quickly. Availability tightens. Access changes. This is not speculation. This is how every constrained asset behaves under pressure. Now, I want to bring your focus back to something critical: ownership. Because there is a difference between exposure and ownership. And in normal conditions, that difference is not always obvious. But in stress conditions, it becomes everything. Financial markets are built on layers of claims, instruments that represent value, contracts that promise delivery, structures that depend on trust. And most of the time, that system functions. But when confidence begins to weaken, those layers are tested. People begin to question, they begin to verify, they begin to convert paper claims into real assets. And this is where pressure builds. Because systems that operate efficiently under trust do not always operate efficiently under stress. When too many participants attempt to move from exposure to ownership at the same time, friction appears, delays appear, shortages appear. And the distinction between what is real and what is represented becomes very clear. This is not a theoretical risk. It has happened before in different forms, and it always follows the same pattern. Confidence declines, demand for real assets increases, systems that rely on leverage and abstraction struggle to keep up, and those who already hold physical assets find themselves in a very different position than those who do not. You need to understand where you stand in that dynamic, because if you are holding physical silver, you are not dependent on the system functioning perfectly. You are outside of it in a very specific way. That is not fear-based thinking. That is structural awareness. And in times like this, awareness is what separates prepared investors from reactive ones. In the next part, I'm going to walk you through exactly what you should be doing from here. How to think about your position, how to strengthen it, and how to avoid the mistakes that cause most investors to lose strategic advantages at the worst possible moment. Now, we need to bring this down to action, because understanding the structure is only part of this. Executions is what determines whether that understanding actually translates into preserved and growing wealth. And this is where most investors, even the ones who see what is happening, still make critical mistakes. So I'm going to be very direct with you. If you hold 500 O's of silver, you are already ahead of the majority. But that does not automatically mean you're fully prepared. There are specific decisions you need to make from this point forward, and those decisions will define how your position performs under pressure. Step one is mental, and it is non-negotiable. You need to reframe what you are holding completely. This is not a trade waiting to pay you. This is not something you evaluate based on monthly price movement. This is a reserve. You need to start thinking about it the same way a central bank thinks about its gold. It is there to protect purchasing power across environments where traditional assets fail. It is there to anchor your portfolio when volatility increases. And most importantly, it is there to give you optionality when others lose it. If you continue to think about your silver as something that needs to perform on a short timeline, you will be shaken out of it. That is exactly what the market does to weak positioning. It tests you until you give up. You cannot approach this casually. You need conviction rooted in understanding. Step 2 is security. And I want you to take this seriously because the strategic value of your position is zero if it is not protected. Physical ownership comes with responsibility. You are holding a real asset. That means you must think about storage, access, and risk. If your silver is sitting unsecured, easily accessible, or in a location that can be compromised, you are exposed. That is not a market risk. That is a controllable risk. You should be thinking in layers. Secure home storage that is properly installed, professional vaulting if your position justifies it, redundancy in access, discretion in how and where you hold. This is not paranoia, this is discipline. Because as environments become more unstable, the value of what you hold increases, and increased value attracts attention. You need to be ahead of that. Step 3 is positioning relative to your total portfolio. You need to ask yourself a simple but critical question. Is 500 OZs your final position or your foundation? Because those are two very different strategies. If it is your final position, then your focus is on protecting and maintaining it. If it is your foundation, then you need to think about how it fits into a broader allocation strategy. Dalio's framework has always emphasized balance, not overexposure, but also not underexposure to critical assets. In an environment where monetary instability is a real risk, having meaningful exposure to precious metals is not extreme, it is rational. You need to look at your overall assets and determine whether your current position aligns with the risks you're trying to hedge against. And be honest with yourself, because most people either underestimate risk or they respond to it too late. You do not want to be in either category. Step 4 is understanding leverage carefully. Physical silver is your base layer. It is stability. But there are ways to build on top of that base. Selective exposure to silver-related equities, particularly well-managed producers, can amplify returns when the cycle turns.